You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program for you out there, the busy financial advisor or asset manager. Maybe you're wondering how to take those first steps into the world of options. Maybe you've already done so, but you need a little bit more hand-holding on the exact course of action you should be taking on behalf of your clients. Maybe you're hearing more client demand these days and you want to take some action on that. Either way, we've got you covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Hope you guys are liking all the content hitting you guys pretty much every day. Usually a couple shows a day, 3 hitting you out there today. So put your options trading pants on. A lot of content coming at you. Remember, if you like what you hear, not just for this show, but for everything we do here, leave those reviews wherever you get our content so new folks can continue to discover the network in these trying and troubled times. Also, keep those questions coming. We do love to hear from you guys. And let's see who we're hearing from on the old program today. First, let's go out deep into the Atlantic to a small tropical island known as Puerto Rico, where we are joined once again by the Director of Risk himself, Mr. Chris Hausman, the Portfolio Manager, and indeed the Director of Risk over there at SWAN Global Investments. Mr. Risk Director, welcome back to the program, sir. Have you recovered from your epic appearance on our election night spectacular, sir?
I have recovered. It's good to be back with you guys. And Puerto Rico's not that tiny of an island. There's much smaller out here. But yeah, the election is over, and I guess we can get back to trading, right? The fun stuff.
Yes, that's true. Have you also gotten over the fact that you cannot vote for our commander-in-chief, sir? Has that umbrage passed you by?
I did. It was something I accepted before I moved down here. So, once again, I had my popcorn all night long and kind of watched from the sidelines. I'll let you guys duke it out.
So they give you a sweet, sweet tax rate. They take away that one voting option. Interesting stuff out there. Also, let's dial that clock all the way around now and then back up again, north of the Atlantic there, all the way to the northern hinterlands not of Maine, close. That's where we normally go, over one state over or so, to New Hampshire, the northern hinterlands of New England, where we are joined once again by Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Option Research and Technology Services. Mr. Matt, welcome back to the program. I'd ask you if you recovered, but you've done a couple of hits on the network since the election, sir. So how are things in the land of ORATS in New Hampshire, sir?
Things are great. Beautiful up here. Fall, right in the middle of it. The markets are fun. A lot of people interested in options information. We've never been busier, Mark. I'm sure you could say the same.
Yeah, it's one of those times no one wanted these circumstances, but the end result, at least from an options perspective, has certainly been interesting. And everything else in the world of options has been interesting as well. So let's break it down. It is time to get the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. And pretty much as we have done for every episode in the entirety of the year of madness that is 2020, we've started The Buzz with a little bit of reflecting, a little bit of thoughts on how things are lining up in the current market environment. As Chris alluded to, we are, of course, a couple of weeks past now the big election here in the U.S. Of course, some may say there still is a question mark about the result out there. Either way, the markets haven't really treated it like there's much of a question mark. The markets have been pretty much in full-on rally-ho mode ever since the election, pretty much. You know, they rallied, limit up the futures during the special. Then we saw some sell-offs there. Then the next day, as things started to maybe go back and forth and started to coalesce around Biden, the markets just shot north. Then, of course, we've had all the vaccine news over the last week and a half or so, and all of that has really just added fuel to the fire. So coming into showtime now, we're seeing all the major indices, even today, with the pandemic news looking pretty grim around the country, indeed around the globe. Markets still in the green today, ever so slightly. S&P, if you remember on our special listeners, was threatening 3,300 to the downside. Now it's at 3,612 coming into showtime. So a full 300 points in the S&P since the election out there. So a lot to parse. VIX still hovering in the low 20s, right around 22 and change. So a lot has obviously evolved in the world and indeed in the market. So let's start there. Let's go around the horn the way we started. Let's go out to the Director of Risk. Mr. Risk Director, sir. A lot's going on in the world. As you alluded to, we can maybe get back to trading. What has been catching your eye out there, and what are your thoughts on this kind of endless rally since the election, sir?
Well, every rally has been endless since the great financial crisis, just about, right, in some way, shape, or form. But, you know, we've been talking a lot about this range here in the SPX of 3,200, 3,600, and it finally looks like we're trying to break out to one of the sides, you know, and right now that side is on the upside. On the upside, you know, market's meandering a little bit right now. We need to work off some overbought levels. If we do get back inside that range, I think 3,400 is probably going to hold at this point. We also talked about that double top formation. Probably have to negate that at this point, and we've gone about 2-3% past that. So term structures back in contango. That means markets are nice and calm and and things are looking rosy once again. And I actually think that the VIX at these levels is looking a little bit interesting for a long side type trade. It may be a little soft here with the holiday, but I mean, if you had a good chance to sell in the 30s, and if you got some sales off in the VIX of 40 level, you really should consider taking some of those trades off at this point. I don't think there's going to be too much downside left. And even if we do rally, I think volatility is going to stay firm. You're going to have the call overriders are going to have to roll up. We're seeing a lot of stock substitution type strategies where people are pulling stock off, but they're substituting with call spreads and calls. So I do think that volatility is going to stay firm. It's not going to have this crush even if we do rally. And interesting to note, I did look at the 20. I looked at skew, right, your favorite measurement, right, looking 3 months out in the SPX. 25 delta put over the 25 delta call, and it's only in the 10th percentile over the last year. So that means there's a lot of call buying out there going on right now. And I think, I don't know what the next event is going to be to push this market lower, but given all the signals and where term structure is and how vol has reacted, things look kind of decent. And I think upside is really the path of least resistance right now.
Stock substitution. Interesting choice, sir. I wonder why you would bring such a thing up. Who would think of such a thing in these troubled times? Interesting. Maybe we'll get to that a little bit later in the show. But first now let's go back out to the sharp dressed man, a.k.a. the Oracle of New Hampshire. Mr. Matt, you're always watching a variety of models and indicators out there for the state of volatility and the state of the economy as a whole. What are your models and your indicators telling you right now, sir?
Yeah, I'm just looking back at our blog at blog.orats.com. On November 6th, I was quoted in Reuters as saying, things are mellowing out from a vol perspective. And then I posted a surfing video because I used the word mellowing out on my LinkedIn. So that was fun. And it looks like it's just, I said it looked pretty bullish back then, and it's just been up since then. And then I posted about Russell back on the 9th of November and how these way out of the money calls are just driving that index up. And that looked like the interesting index then, and it still has, almost 2 weeks past that. And they're buying up the Russell small calls, the 5 deltas calls divided by the 75 deltas is the highest that we've seen back to when we were keeping records in 2007. So that continues to be the case. And the Russell's driving today. It's up 82 basis points, and the rest of the market is about flat. And that's been the case over the last few weeks. So the Russell's really catching up. The call buyers are there. Who knows if it's the whale, if it's the dolphin, if it's the Robin Hooders, but the ORATS looks at the component stocks and the regular ETFs, and the component stocks are the ones that are really driving it. So that's what's catching my eye, Mark.
Well, since we're talking about what's catching your eye, Mr. Matt, let's stay there for a second, because I know when you're not busy looking at, let's say, the skew and the Russell 2000 and what's going on in the volatility landscape, you're also busy crunching a few numbers out there on the earnings side of the fence. And, sometimes it's easy to forget, given how much macro madness is afoot in the market. It's easy to forget that there are earnings popping off out there. And in a normal year, these would be driving the market hither and yon. So we are still deep in the heart of earnings season, sir. There still are major corporations reporting pretty much every day. And you guys have been crunching the numbers diligently over there in ORATS land, the earnings move results, and the earnings season reports. What's standing out to you so far this season, sir? Is it yet another blood red season for volatility and premium buyers, sir?
It's a blood red season, Mark. Today was actually the best day for option buyers. TJ Maxx and Lowe's are moving more than they're expected by our straddle. That what we do is we look at the straddle, but you can't just look at what that percentage is. You have to see how many days are left, and then you have to calculate what you think is going to be left in the straddle based on the normal distribution. So we have quite a process that we go through to estimate the moves. And so today has been pretty good. Target came in about what was expected. But yeah, as we've talked about numerous times this earnings season, it's just going from bad to worse. I think we talked, it was 71%. It's at 69%, what that means is if you're buying a straddle, you're only getting back 69 cents on the dollar after earnings. So pretty bad. We've guessed at a certain number of things why we think that's happening. Is it a lot of the new players coming in just buying, and it's driving stock movement? The VIX is so high just because of all the macro events, and they're not really looking at the micro earnings. But yeah, we're now in week 6, and it's not looking good for option buyers. We had 1 week that looked okay, but as that settled down, it was still slightly under 100%, and so yeah, not a good earnings season for option buyers. As these reports trickle in at the end, sometimes they could get some decent results. We've got a few still yet to come out. NetEase, Ross Stores, WDAY. There's still quite a few that are out there looking to Autodesk report over the next weeks. Dell, Gaps, HP, Nordstrom's. So there's still some action out there, but overall, Mark, not too good for option buyers.
Yeah, you're right. We saw a brief flurry where we managed to cross 100% ever so briefly this season. But other than that, we're hard-pressed, Matt, to find another even week in any cycle this year that has been north of 100%. Can you think of any off the top of your head? It's been quite some time since earnings movement has exceeded the juice, sir. Yeah, no, we what was it? Last season we thought was bad, but this one's gone to worse. And it's hard to pinpoint how it can possibly be this bad, but it has been. So I haven't seen that in since we've been tracking it. You helped us get into it and had some ideas for us a few years back, and since then we haven't seen it this bad. Yeah, I guess that's when we'll know the worm is finally starting to turn in the broad market and the broad economy, when names start to outperform their earnings straddles again. And it starts to move the market again, because right now you're not seeing any of that. And we haven't pretty much for the entirety of the mad year that is 2020. Speaking of the mad year that is 2020, it's been just an endless year of negative headlines and bad news. Just when you think it can't get any worse, it does. There's triple hurricanes in the Gulf, or take your pick on the pandemic front or the political front, whatever. Pick your poison out there. They're all pretty bad. And so you'd think this would be a terrible year for a lot of different sectors, including the sector that listens to this show, the registered advisor audience. I think this would have been a bloodbath out there, as people, obviously we talked about the retail trading boom. More people are taking their trading into their own hands. What do I need an advisor for? The market got annihilated earlier. People may be sitting in cash. They don't want to touch the markets. Either way, you think this would have been a bad year for advisors. And yet, at least looking at a survey out of here by the Investment Advisor Association, looking back on the year that was 2020, at least so far, actually kind of the opposite. It looks pretty good overall. The number of SEC-registered investment advisors grew almost 4%, 3.9% over the year 2020. So that's pretty impressive. The number at the end of the year was about almost 13,500. That's an increase of about 501 registered advisors out there. So for all of you out there thinking maybe this was a dark time for the investment advising audience, and maybe the audience of this show might have been getting laid waste by various issues out there in the financial space, and seeing the number of advisors out there drying up. No, actually not the case. Also, a lot of different fronts. Looks like advisors were growing. They reported adding up about 4.5% of employees over the course of this year. That's impressive as well. Their aggregate AUM has grown to a record $97.2 trillion. That's a 16.2% jump from $83.7 trillion. A lot of that, I'm sure, due to the massive V-shaped recovery we saw throughout. I wonder how that number would have looked in the nadir of March. Probably a very different story. And it's been pretty much good news across the board, which, quite frankly, I thought was a little bit surprising. I don't know, Mr. Director of Risk, we'll start with you. Did these numbers surprise you as well, or did you maybe expect that the advisor side of the business, a.k.a. the audience for this program, was actually thriving in this year, sir?
Well, it's been an interesting year, and there's been a lot of people that are seeking protection and hedging and what have you, and also the speculative crowd that think there's a lot of opportunity out there. So really, I guess I'm not surprised in a way. I think, when you have all these unknowns and the way the market has traded this year, and really a market that I would have to say most people who are invested or trading have not seen this kind of market in their experience. That's when you have to reach out for other people who have seen this kind of market, who do have that experience to take a person's portfolio and hedge out those risks and kind of custom tailor it. So, in a way, I'm not surprised. I think it's just a more and more people reaching out saying, look, this is a very challenging market and I need to seek expertise. I need to seek people who've been through this before and can navigate these turbulent waters. Yeah,
same question for you, Matt. I found this surprising. Sounds like Chris is a little bit mixed on that. Where do you fall on this? Were you surprised, as I was, that the advisor industry, a.k.a. the audience for this program, continues to grow and thrive, sir?
Well, not really from the amount of queries that we're getting from that end. Seems like people are coming to them more for options, actually. And we had to register, so I think that there are probably stronger registering criteria. Like we're not managing money like Chris's firm is, but we're talking to people about back tests and about that. So our lawyers thought that we should register, and we did. So, I think that could be driving it. And also, people are coming to us. We're getting a lot more consulting requests. So, specialized option back test and implementation. So I think people are reaching out to advisors that can offer that type of services to clients. We're actually starting another sister firm to ORATS that has to register. So there's another register that's going to be more consulting based, because ORATS wants to concentrate on our tools and our automation and our data. And there's going to be a consulting firm coming related to ORATS, so they have to register. So there's quite a bit of demand for people wanting help. It doesn't necessarily mean that they're all going to be the typical registered investment advisor. Some people have to register just to give advice. So not that surprising to me. What was surprising is Jim Simon's firm that has been killing it at Renaissance for all these years, had a bad 2020. I don't know if you saw that, but they said they were too long on the way down and too short on the way up, or he had some other fancy words for it, but that's basically what happened. So he could have used a registered investment advisor, or he could have listened to this show, Mark.
He should have called up ORATS, or perhaps the coming sister firm to ORATS. Is that going to be called SORATS, Sister of ORATS?
Option Research Consulting, but I don't think I'm able to say that yet. So forget that I said that.
I like SORATS. Put my money down on that one. All right. Speaking of putting your money down, how are you putting that money down these days? And we've been saying for so long here on this program that the old school methodology, the things you and I may have learned in college, even when we're taking our basic finance and markets courses and things like CAPM and full diversification and all these things you probably learned about a long time ago, including the notion that a lot of advisors still hold to out there, that the optimal allocation for people out there is the old school, reliable 60-40 portfolio, 60% in equities, 40% in some sort of fixed income type product. If you've done that, if you put your client in that, you can wash your hands and say, I've done my due diligence as an advisor on behalf of my client. We've been saying for a long time here. In fact, that's pretty much the impetus for this show. That's what got it started, is to say, you really can and should do a lot more. And the notion that 60-40 and you're done and you're somehow diversified and you've protected your client's assets is kind of absurd. Now, we've been saying that for a long time. I get it. We're the options folks, so maybe we're kind of speaking from the choir in this sense. So some folks say, of course you're going to say that. You'd rather have someone buy a put than just do 60-40 or something along those lines. Well, now it's not just us saying it anymore. JP Morgan, kind of a stalwart out there in the traditional asset management, buy and hold, long equity world, coming out and saying, you know what, that old school 60-40 portfolio, yeah, not so much anymore. They came out today in their asset management report, and they have their capital market assumptions report, and they're saying the 60-40 portfolio, which they term the stalwart for many, many years of American investment, has been cut down to the point where it has reached in their models just an expected 4.2% return. They say that's just too anemic, and as a result, the impetus, they say, to move beyond the 60-40 model is stronger now than ever, even after the great financial crisis, they say, according to their analysis. And interestingly enough, the solution they come to is one that may also sound familiar to listeners of this show. They say you need to go out and more aggressively seek out alternatives. Now, they include an interesting list in their alternatives, and this is an issue we brought up in the past on this show, the rubric of alts and everything that gets thrown under there. They include real estate in there, private equity, which is not a really reliable alternative for a lot of individuals out there, and also hedge funds. Now, when they say hedge funds, that starts to ring into our neck of the woods, which is, of course, the hedging and actual derivative side of the fence. So they even say the use of alternatives to provide income and diversification, those things may sound familiar to listeners of this show, is more imperative than ever. So interesting times. Let's go around the horns the way we went again. Let's start with the Director of Risk. Mr. Director of Risk, we say this on the show all the time. We've been saying for years that 60-40 is dead. I'm sure you guys at SWAN have done one or two white papers on that very exact subject over the years. But now here we have a much more traditional, much more buy and hold long equity type firm kind of coming out, A, and saying the same thing, and then B, recommending the alts. What do you think about that, Mr. Director of Risk?
Well, markets change, and this is a theme here at SWAN that we've been telling everyone, that the 60-40 portfolio has just been dying over the years. It's not giving you the yield that you expected from the bond portfolio, and it's not providing that diversification or that protection, when you do get these violent drawdowns or bear markets, if you will. So it's good to see that everyone's kind of turning the corner on this one. This is a theme that, like you said, we've been saying it on this show for a while. It's been something that we tell all our clients, and we've got a lot of great resources on the 60-40 portfolio and on why it's kind of just dying out over the last few years. So, it's good that mainstream, and this is why the show exists, right? We're trying to get mainstream in love with alternatives, and our side is alternatives via options to hedge or options to produce income. So I think, it's good to hear, and I think this kind of ties in nicely with why advisors are growing a little bit, because people are turning away from this classic 60-40 portfolio, and they're like, well, I do need to use alternatives. I do need to use hedging mechanisms, but I don't know how. So where do I get that advice? You come to this show, first of all, and then you seek out an advisor's advice.
Yes, you come here first. This is your starting point. And then you branch out maybe to Swarats, the sister of Orats out there. Mr. Matt, as folks are seeking out your sister firm over there, what are your thoughts on what we've been saying for ages? Now other folks starting to parrot that. The 60-40 portfolio, sir, stick a nail in it. It is done.
Well, people went to 60-40s when they didn't have a lot of other options. Bonds were supposed to move opposite of equities. And, for a while they were able to do that type of a ratio. But now you have a lot of other opportunities to look at other asset classes, and you've also seen some violent market moves and what happens to correlations. They just go to one. Everything goes the same way, and that's down. I mean, gold, crypto, equities, bonds, everything down when there's a severe market turn. The only thing that's contractually guaranteed to be negatively correlated to equities are puts. And you have to have some puts in your portfolio. I mean, it's an asset class. It's the only one. And it's just so great to have when this. I've been talking about it when before COVID hit. Have some puts, and it just makes your life so much better. You know that you have some protection down there, and a lot of these other alternative investments might work out, but they're not as guaranteed as puts are. I've been to many of these RMC events, risk management conferences that the SIBA put out, and puts are expensive, no question, but we've tested a lot and back tested a lot of put scenarios that can be at least more palatable. But some people are saying, here's a way to have your cake and eat it too. And some of those have not worked. On downturns, I mentioned Jim Simon's group. They have some of the most PhDs in one place in number crunching, and still they managed to not do well in this drawdown and subsequent, jump up in the market. So, if you have puts, if you have equities, that's just an easy way to, have peace of mind when the market goes down and still participate when things are looking rosy, Mark.
I like that, the notion of puts as an asset class. We've been talking forever, is volatility an asset class? But I've said that many times. Puts are really, at the end of the day, the only reliable source, and as you put it, the only contractually obligated source of real, true inverse correlation. You know exactly what you're getting out there when you buy a put. It's in the contract. It's all there no matter what else happens. As long as OCC stands and the earth turns, you will get your put obligations and you will be able to exercise those. So yeah, maybe that should be a discussion for another day. Puts, forget volatility, puts as their own asset class. I kind of like that conversation out there. But it's time to have another fun conversation. Chris alluded to it earlier, but it is a timely one, so let's get to it. A little bit of the old Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the program where we break down usually a basic and introductory options concept or strategy and explain how you can utilize it in your clients' portfolios. If you listened to last episode, we talked about some interesting hedging scenarios you can use to hedge event risk, like, let's say, an election or an earnings call or perhaps a crop report if you're out there in the commodities, whatever the product is, different strategies you can use with options to hedge that risk. One of the ones we touched on very briefly at the end is something we're going to revisit today. In fact, Chris alluded to it at the top of the show. He said he's seeing a lot of stock substitution out there in the broad market right now. We've noticed the same thing, which is why we thought we would devote our Options 101 to that exact topic, the notion of stock substitution. We're coming into this show, stocks are at or threatening new all-time highs pretty much every day. A lot of people out there are starting to get a little bit worried about valuations. They probably want to take some risk off the table, but they also think maybe there could still be more upside ahead. That's pretty much the ideal scenario for what we're talking about today, the old stock substitution. So let's break it down. Let's go back to our old friend, XYZ, the name we've all made and lost many fortunes in over the years. XYZ, back at our magic level of $100. So you have your XYZ, you're at 100, maybe you owned it from 75. You had a nice run, maybe from 50, looking at the analogy close to what we've seen of this year. You had a nice V-shaped recovery in XYZ as well. Either way, you're sitting on some gains and you're saying to yourself, I think we could still rally here a little bit, but I'm really worried about a retracement. Let's say back down into the 80s maybe, or maybe even more. So what should you do? Well, in our scenario here, we're going to do a stock replacement. What does that imply? Well, you're going to replace your stock. It's very basic. So first off, you have to sell your stock. So if that's a deal breaker for you, I know a lot of you out there have tax sensitive clients. They don't want to deal with capital gains. If that's an issue for you, then this strategy not going to be for you. But first thing you're going to do, sell your XYZ. You're taking that off the table. You're collecting your $100. You're putting that in a nice rosy cash account. Got your $100. Now you turn around and the second part of the stock substitution, you're going to substitute it with something else, a position that approximates what you had before, which was a long stock position. Now, how do you do that? Usually you go to a call because that's going to have the same bullish long delta perspective that you're looking for. And you want an in-the-money call. You want a deeper in-the-money call. Why? Because you want something that's close to your stock's delta. Remember, your stock has a delta of effectively 100. It moves. It is stock, so it moves 1-to-1 with stock. So you want something that's going to come close to that 100 delta. And obviously you could spend a lot of money to get fully 100 delta, which is why we recommend, and people usually, again, it depends on your method of engagement. I'm sure the director of risk and the sharp dressed man will have their own thoughts on how to approach this. Everyone does it a little bit differently. But typically you start off usually around 6 months out, maybe longer. Some people like to go longer, a year, maybe even longer, beyond a couple of years out there. And how far in the money? In our example, we're going to buy a 6-month call option on the 75 strike. So we're $25 in the money, listeners. And in our example, that's going to cost us $30. So we're paying $5 in extra premium for that. So you took $100 off the table. You put 30 of it back to work. So now you can just do the basic math there. You got $70 sitting in cash. That nothing can happen to that. That is in cash. So in the worst comes to pass, XYZ goes to zero, you're still going to have your $70, which is nice for maybe a risk-averse client. Now, the other thing is you bought an option that has a lot of intrinsic value, which is nice in the fact it's expensive. Obviously, we spent $30 on it, but really, at the end of the day, one of the main concerns when it comes to buying options is the impact of time decay, how much that option's value is going to decay. In this case, the only part of that option's value that's going to be impacted by time decay is that extra portion, that premium, that extrinsic value, which in our case is only $5. So you really only have $5 worth of exposure to those other external risk factors, time decay and everything else that usually really dominates a long option trader's lifespan. So now you have an option, 75 delta in our case, and a 75 strike. So that's kind of nice because you have, every tick in the underlying. You're not going to get full participation. That's one of the downsides of this strategy. If you have the stock, obviously the stock ticks up $1, you make $1. In this case, we have a 75 delta, so the stock ticks up $1, you're going to make 75 cents. You're not going to fully participate until the stock really starts running a little bit and your delta gets higher, closer to 100 out there. But again, you've put aside capital. You've got a position that is a very close approximation to what you had, and it only cost you about 30% of your capital. Well, if you go out and buy stock on margin, the best you can do is 50%. So this is already much more capital efficient, and you've got a position that pretty closely approximates what you had before. But one of the downsides of that, you're not going to participate 1-to-1 to the upside. So whatever your delta is, that's your rate of participation. Obviously, that delta will change as you rally. Go back, check out our episodes on the Greeks if you're concerned or confused about that, how gamma changes your delta. But in essence, the stock's going to have to rally a bit for you to really start participating 1-to-1. And the other real downside to this, again, I pointed it out earlier, is if you have tax-sensitive clients, this is not going to be a strategy you want to pursue because it's going to involve some capital gains, and that may spook some people. So there you go. That's taking your position off the table and replacing it or substituting, in this case, with a position that costs a lot less and that approximates a lot of what you had before. So an interesting way to approach these markets if you are indeed concerned about lofty valuations out there. Chris, you kind of just alluded to at the top of the show how you're seeing a lot of stock substitutions going on out there. A, what are your thoughts on this strategy? What are your thoughts, B, of its use case right now in this particular market environment? And then C, do you have any upgrades or tweaks you like? Like you mentioned earlier, people doing verticals. Do you prefer to do it that way? What are your thoughts on the optimal implementation of a stock substitution, sir?
So the optimal one is the one that the client wants for their overall investments, okay? And then our job as advisors is really to assess the volatility landscape and the skew landscape and then technical landscape to see if that thesis, the client's thesis or the investor's thesis, is plausible. So I do agree with you. If you're going to be buying options, I think 6 months really is that pivot point where it's difficult to buy shorter term options because of the theta decay, et cetera. We're seeing a lot of people who are just doing call spreads, taking off their chips, selling their stock and doing call spreads because they don't think there's going to be too much left in the rally. And that also cuts down on the vega or the volatility exposure. Another one we're seeing a lot and people are liking are taking half their stock off. And then doing call 1x2s, okay? So ratio spreads. So they're buying a call spread and selling an extra call because they are willing to get assigned on whatever stock they have remaining, but then they still have 50% in stock, and then they have that embedded call spread for that zone, and they get participation to the upside. And then the more aggressive people are really saying, all right, I'm going to sell all my stock right here, but there is a level where I want to buy that stock back, and those are the people who are going into, they're selling downside puts and using those proceeds to fund upside calls. So if the rally continues, they're going to participate pretty much 1-for-1, but they're still interested in buying their stock back at lower levels. So yeah, there's a lot of things you can do with stock substitution. We're seeing a lot of different variations, but again, it always comes down to, what the client and what the investor wants.
You're right. There are a lot of different flavors, a lot of different ways you can go with that. I like the way you mentioned you don't have to do all of it. You can do some of it. You can do ratios. There's a lot of ways to play with this strategy listen, which makes it nice. It makes it very adjustable to the needs of your clients out there. Matt, same question for you. You're the guy I turn to for all the back testing and all the thoughts on optimal allocation. A, what are your thoughts on the stock substitution as a whole? Are you a fan? B, what are your thoughts about it in this environment? Of course, we are in a pretty optimal environment, some might say, for that. And then C, as we just talked about with Chris, what are some of your ideas for alternate flavors that you like in a stock substitution realm, sir?
Yeah, this is a juicy one. And I looked, is XYZ. I hope no one ever uses XYZ, or we're going to have to change.
That would be funny. That the entire industry would have to change everything overnight if someone decided to do that.
What I like to do, too, is I like to guess what the call delta. You have it as a 75 delta. I would guess that's much higher delta, but let's just go with your that.
Yes, it would be higher. I agree with you. I try to keep things simple for the listening audience.
So anyway, one of the ways to think, I think that if it was a 75 delta, it would be a very, very high premium stock. It's not perfect, but one way to think about it is the inverse is the chance of it hitting that strike. So maybe a 25% chance, but I think it's a lot less than that. So, there are two ways to look at it. One, what I like to test are extremely long-term SPY, way out of the money puts. And that's what I had going into COVID, and they were very nice because they have it's like 500 days on them, and they have quite a bit of vega, and they don't have much theta. So what that means is that they're not going to decay very fast, but the vega kicks in, and those go up a lot faster than their delta might imply. So if you're in a position that you can't sell your positions, or you're somehow long the market in your various investments, way out of the money SPY puts are the ones that we've tested, and that looks like the best risk reward to me. Now, if you're able to replace your actual long stock with options, the thing to do is to think about, what I always said was hedge your happiness. So if it goes up to a certain point, would you sell? Well, if that's the case, you might sell a call there to help finance. If it went down to this level, how would you feel? Well, you'd feel very bad. So buy some puts down there. So I like to do it on a feel basis and then back test that. So. And what I also like to do is just talk to a client and say, what are your goals? How would you feel about it if it went up there? How would you feel about it if it went down here? And usually a long stock payoff picture that is just a straight line isn't really what they want if you talk about how they're feeling at each point. And you could really use options to get that investor a payoff diagram. And a payoff diagram, of course, is just like, what is my profit if the stock goes up? What is my profit or loss if the stock goes down? Show them that and build that out and do some simulations, and you could construct an optimal looking payoff picture for that person. And that's what stock replacement to me is really all about, is they have an outlook. They've done their research. They've read the reports, and they want to take a position, but what if it goes way up here? What if it goes way down here? Is that really what you want to do? People will say, yeah, I'd be happy to buy the stock, 20% lower, until the stock's 40% lower, and you're buying it 20% above where you are, or more than that, actually. But so, how are you going to feel at each one of these points? Puts in stock, or just a long call, or a long call with stock. One thing that we're testing now, I'm seeing is a in the money call and an at the money short call. So if it stays here, you make money. If it goes up, you make money. You don't make as much as if you just had the call or just had the stock. And if it goes down, you're somewhat protected. So there are a lot of different ways to do stock substitution. Look at payoff diagrams. Look at long puts if you can't sell your stock. That's the way I approach it, Mark.
Interesting. Yeah, in our example, I picked the 6-month 75 Delta call. But like I said, everyone has their own flavor, and it's going to vary for you, the advisor out there, depending on your client's needs, as Matt and Chris just broke down. I'm curious, Matt, for your own personal use, your go-to. I know you like long-term puts. You kind of just broke it down for us again there. Do you tend to go a little bit longer term on your stock substitution as well? Do you go out, let's say, a year or more? And do you also, what kind of delta range? Like I said, my ballpark here is just 6 months, 75 delta, but everyone has their own flavor. What's your personal kind of go-to when you put one of these on?
I'm just looking at one of these positions I put on. I love this. It was ZNGA, the Jan 22.7 calls. I got it for some really low price, and I've been selling, calls against it. So, that's 429 days today, but I think I did it when it was more like 475 days. And, so you could get these without much premium, and you have such good participation if the stock goes up. And there's very little theta, and you sell a call, you just keep selling calls against it. And you have some protection that the call premium gives you that you sold, and it's a lot cheaper than buying the stock, but you still have a very stock-like position. So it depends. I like to look at the option, but it depends a bit. But something along those lines is what I like to do, Mark.
I had a feeling you like to go a little bit farther out there, sir. As Matt pointed out, we're talking about this now in the realm of stock substitution, but it doesn't always involve having to sell your stock. You could just, and next time you want to put on a stock position, instead of doing that, you could go the longer term in the money call route. Again, you're substituting buying the stock for buying a in the money call, and you get a lot of the same benefits we've talked about here, and certainly a lot more capital efficiency. Something to think about as you're looking at allocations for your clients. Now, speaking of things to think about, you guys always give us great ones. It is time to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, let's get to it with your questions. We were just talking about how far out to go with a stock substitution strategy. Mina has a similar time frame question. Mina wants to know, has the team at SWAN tested out different variants of the DRS with different put maturities, perhaps 6 months and 1 year versus the current 2 year? Thanks for reading and for putting out this show every month. Well, you're welcome for the latter there, Mina. And as for the former Mr. Director of Risk, what do you have to say for Mina? Are you guys out there ballparking and testing out different variations of the DRS all the time, sir?
Yeah, we have tested several variations, and kind of like Matt, we like going in the longer term because there's less of a drag from the theta perspective. Also, volatility is a lot more stable back there. Now, again, when you're hedging your portfolio, it's like, well, what are you trying to accomplish? Are you trying to hedge over a full market cycle? Are you trying to hedge the real bear market where you could see 40, 50% type drawdowns? Or are you really just trying to hedge out a 5 to 7%, buy the dip type of event that could happen over the next month? So, I've always said this, and I think I've said this on the show many times, is every hedge has its day. I don't think there is any perfect hedge for every single scenario. But so it depends on what you're trying to do. Is it short-term type hedging, or is it long-term type hedging for an investor who wants to be in the marketplace for the next 20, 30, 40 years, which is pretty much what clients are to advisors, right? They're in this for the long haul. And so as far as the volatility is concerned, it can be very difficult at times, during events to hedge. For example, if you went at the end of March this year, if you looked at a 5% out of the money 30 days out, that annualized cost was about 45%. The 3-month was about 25%, and the 1 year was around 11, 12%. So, it's kind of like your house is on fire. It's the worst time to go out and buy insurance. And that's kind of why we lean to the longer term so that we don't have to time these events. Now, again, it's not as effective during these short-term 5 and 7% dips because of the gamma effect. We just don't quite get the deltas that you think you're getting during these smaller type events, but it's not built for that. It's built for the larger type drawdowns. Oh, and I did want to say this about Matt. I asked Matt to put that the easy button in his ORATS platform, so now he has to put the drop-down when you're selecting all your strategies, when you go to the ORATS thing, on how you feel, and then maybe it'll just kick out what strategies you should do.
I like that. Maybe that'll only be available at SORATS, the sister to ORATS site. That's coming soon, listeners. So stay tuned. Stay tuned for that one. Look for the easy drop down there. Let's go on next. I like this. This might get our handle of the week here. The hamburger. Can't even say it with a straight face. Hamburger Rhino says, I've heard you refer to the Morningstar, quote, alts ghetto on previous shows. What categories would you prefer to see for options-oriented funds going forward? Yeah, this is something I've commented on a lot in the past. We just referred to it earlier here when JP Morgan was talking about alts. Look at everything they threw into that alts category. Private equity, hedge funds, real estate, a bunch of nonsense that really doesn't really go with each other at all. That's kind of why it goes in the alts category. And unfortunately, what Morningstar does is it throws in all that stuff, along with the covered call funds. And they even take different options-oriented funds and throw them all together because they're options-oriented, even though not exactly the same strategy. And yet that's all lumped together in the exact same type of thing. So there's a lot that I would like to see. But I think at the very least, pulling options just out of the alts, don't put it next to private equity and everything else like that, or managed futures, all these things that really have nothing to do with it. Make them separate entirely. And then within that options-oriented, you have to go deeper. You can't just go surface. You have to have income-based strategies. You have to have, some sort of a hedging-based strategies, which, of course, there's going to be some drag on those. So you have to separate those out a little bit because those are probably not going to outperform in all scenarios. But when they do, you want to make sure you have that broken out as its own category, and then maybe some type of more speculative type strategies in there as well that are looking for appreciation, looking to outperform on a pure return perspective. There's a lot of different ways we can go with this one. We probably spend the rest of the show debating this. Let's go out to the sharp-dressed man first. What would you like to see from Morningstar? They throw options pretty much just into alts, but if you had your druthers there, Mr. Matt, what would you like to see? How would you like to see them break it down there, sir?
Well, as an investor, you want to compare apples to apples. Now, from just a typical funds that they look at without options, it's pretty easy. It's either long, short, or short. So, but options, as we know, are complex, but they're not that complex. You can't just throw them all in together. Then you're not comparing anything. So what you want to do when you're comparing strategies, is it a kind of leaning long strategy? Is it a short vol strategy? Is it a protection strategy? That's how I'd like to see them break it down. So, obviously it's going to cost you more and your returns aren't going to be as great in an up market if you're a protection fund. But, and you would have done better, obviously, during COVID if you were a protection fund. But, what you want to do is when you're comparing these funds, you want to group them together, apples to apple. Who's really doing better at what their stated purpose is? And it doesn't have to be that many. It just has to be, along those lines. Are you long? Are you short? Are you long vol? Are you short vol? Are you long deltas? Are you short deltas? Is it just something to help compare how these firms are doing against one another? Mark,
Mr. Director of Risk, same question for you, sir. If you had your druthers, you could wave your magic wand there and make the categories however you want it over there in Morningstar. What would you like to see?
Yeah, I agree 100%. I think to keep it very, very simple, I just divide it up into three categories. Hedgers, then you have the covered calls and the put writers. Those are your two biggest groups, and then the other. And you can call it the volatility guys or opportunistic, but there's a lot of different types of strategies in that category, and I think it doesn't to rank hedgers against the others or the put writers and covered calls against the others, or it doesn't quite make sense all the time. So I do think there needs to be some type of delineation within this category. It's something we've been talking about here for years.
Yeah, I think we all can at least agree on those kind of various categories. Separate out the hedging because that makes no sense. Separate out the income even, that also makes no sense. And then what that third or other category should be, that's where it gets a little bit maybe more interesting. Should there be some sort of, just speculative category, as you put it, and other, that would be kind of that would be throw everything else in there. Or as Matt says, maybe some sort of long ball type thing. There's a lot of different ways you could parse that /third column, but the first two I think are pretty clearly delineated out there. Speaking of covered calls, let's go to this one here from Nellis. Nellis says, does it make sense to write covered calls on dividend-paying stocks to increase the yield, or is that already priced into the value of the options? Well, yeah, spoiler alert, listeners, Nellis and everybody else. If you have a dividend-paying stock already, you're going to see some of that reflected in the price of the option. You're not going to get as much bang for your buck selling that call as you are on a non-dividend-paying stock. But that doesn't mean you shouldn't do it. I mean, income on top of income is always a nice thing, right? You're already getting paid an income stream, and now you're making a second income stream. What's not to like about that? Just that secondary income stream may not be as juicy as you might expect. Let's go around the horn. Let's go the opposite of the way we just went. Let's start with Mr. Matt. Mr. Matt, sir, what are your thoughts here on doubling down, getting that second income stream from a name that's already paying you dividend income, and now you want to write covered calls on top of that, sir? Should Nellis even bother?
So we do, as you can imagine, a ton of testing on calls, and the quick answer is dividend-paying stocks don't do as well in this category. You need some premium, and a lot of people that are buying dividend stocks are already in it for the yield, and they'll try to sell some calls to get more yield. So that's the kind of category of investors that are investing in those types of stocks, and the volatility is typically lower and the premiums are lower just because of the supply and demand. So in our testing, the dividend stocks don't do as well on those call selling. We'll look at things like, you have to have at least this much of a call yield, and we want a list of stocks, and we want stocks that have some outliers. What we're doing a lot now too is we'll get a list of stocks, we'll have back tested it, and we'll find the stocks that match, but then we'll be really patient, and we have some more execution parameters that will find a stray bid on a call that is really juicy. And then if you could augment your returns with selling calls on stocks that have high premium, and then finding the right stocks within that option chain, that's how you really do it well. But what we found for many of these just generic dividend paying stocks, usually low volatility, and you're not getting as much bang, and when they go up, and you're giving away a lot when you're selling that call, Mark.
Yeah, this is an interesting topic. We could spend a lot of time discussing it here, but the final word, has to go to the director of risk on this one. Mr. Risk Director, the covered call, obviously a tried and true go-to strategy for a lot of advisors out there. A lot of those advisors also putting their clients already in high dividend yield stocks. So what do you think? Should they even bother doing the extra income leg, sir?
Well, there's no free lunch, and it's the concept of banking and put call parity. And I agree with 100% with everything Matt just said. But I just have a quick question. I know I'm going to extend your show here, so you can yell at me later. But going back to that 5 delta call that we talked about in the Russell or IWM, is it really that people are going after the 5 delta option, or is it more a function of they're looking for a certain premium and it just happens to be the 5 delta option? Because I know there's a big thing going out there where people are going into these baby options not necessarily looking for a delta, but really, well, it's at 10 cents and I could be a 2-bagger or a 5-bagger. I guess that's the question, if Matt has seen any of that in his research, that for me, it would be I'm always going to look really for the delta and put that delta into some structure. But do you see more of the retail people kind of just looking at premiums and saying that's the one I want, and it just happens to be the 5 delta? Yeah,
well, right now, the ratio of that 5 delta is the reason that we pointed it out. I mean, the 25 delta, we measure at every 5 delta. So, the 5 delta is the one that's sticking out the most right now. Are they going directly for it? Probably not. But what we think is that what's happening is these market makers are short so many of these calls, and they need units. They need anything they could get, and they're going. I think the Robinhooders are buying the small options. I think the market makers are short, and they're trying to get some units in. As the stock rallies, as we all know, they're getting short gamma. They're looking for any type of option that they could get. So, again, I agree with you. You're not going to necessarily say, hey, I want the 5 delta, but I think there's a lot of factors involved. The lowness of price, that typically will kick up if you're short other other options. Just you want to find some units. I think that's what's happening. And then just the short gamma and the small prices is leading those implied volatilities higher, Chris.
There we go. Unfortunately, we'll have to leave it there. We could talk small caps and deltas and getting out to should you write covered calls on dividend paying stock. A lot of great topics today. Stock substitution, all these topics we could fill many hours with. Unfortunately, that music means we've come to the end of yet another hour-long sojourn through the world of the advisor's option. But before we go, if you have questions about we talked about a lot of stuff on the show today. You probably have some questions. If you have questions about any of these topics, maybe you want to learn more, maybe you want to reach out some of our cohorts, see what they have up their sleeves that may interest you. Let's go around the horn and do just that. Let's start with the director of risk. Chris, you guys, I know, have stuff over there at SWAN about the 60-40 portfolio and its impending demise, but also topics about covered calls, about research. Maybe they have questions about all this stuff. Someone obviously just asking about different term structures of the DRS. If folks have questions about all this stuff, where should they go? What should they do?
SwanGlobalInvestments.com to start off. Our latest piece is called Stimulus Stalled, an Antitrust Storm and More Market Turbulence. So even though the election's behind us, investors should always anticipate turbulence in the markets and should protect their portfolios accordingly, something we talk about here all the time.
There you go. SWAN Global Investments is the place to go to find it all for yourself. And, of course, give them a follow on the old Twitters as well, at SWAN Global. You can get some of those nuggets they tweet out in between episodes of this show. You can get their newsletter, the good, bad, and the ugly, all that white papers. Chris was always talking about the research from their team over there, as well as links to a cool little show called The Advisor's Option. What more could you ask for from an advisor-oriented destination? SWAN Global Investments, the place to check it out. And Mr. Matt, as we're all awaiting with bated breath the launch of SWARATS, a.k.a. the sister to ORATS. If folks want to kick your tires or ask you questions, clearly they have a lot of questions about all the topics we talked about today. Where should they go? What should they do?
Well, whenever I come on the show, I get more work. Chris wants me to now hedge my happiness. How do you feel at each part of the payoff picture? We're going to need therapists over here, helping you through your options. But come on over to orats.com. We have a ton of stuff from just the raw data that we use to generate these back tests and reports and such, all the way to execution. I mentioned trying to find the best options. We're always calculating a smooth market volatility, and we're able to get these theoretical values in and see where the good trades lie in even the range that they're looking for. So we go from soup to nuts at orats.com, Mark.
Soup to nuts, orats.com. Check it out, orats.com is the place to go. Also give them a follow on the old Twitters as well, at OptionRats. You can't forget that one, at OptionRats. He's always tweeting out nuggets to links like the Russell Call article, the Russell Skew article we talked about earlier in the show, and a lot of other great nuggets hitting them over there as well. So ORATS as we're waiting for the launch of SWARATS, go to orats.com and check them out on the old Twitters at OptionRats. Of course, check out our friends over there at the OIC as well. Optionseducation.org is the place to go for all their great advisor and indeed retail-oriented educational topics. A whole bunch of great stuff over there. And on behalf of Matt and everybody over there at ORATS and the director of risk and everybody over there at SWAN and our friends over there at OIC and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in so many awesome questions. I think for our December episode, we'll probably do another all questions considered episode, so get them in. We're going to unleash you guys on us, so it should be fun. Stay tuned for that, and we'll see you back here next time for another episode of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.